This is the story of how silver just shattered its 45-year price ceiling and why some of the world's top analysts are predicting it could surge past $150 in the next 12 months. January 14th, 2026 marked the day silver hit an all-time high of over $92 per ounce, demolishing the previous record set during the infamous Hunt Brothers scandal in 1980. What makes this different from every other precious metals rally in history comes down to one thing. This time, speculation isn't driving the price, physics is. Let me show you exactly what's happening in the silver market right now and why it matters to your financial future. 2 years ago, in January 2024, you could buy an ounce of silver for around $23, and by January 2025, it had climbed to about $29. Nothing too dramatic there. That's when something changed. May 2024 brought the first crack in the dam when silver broke through $32 for the first time in 11 years, and traders started paying attention. October 2024 pushed it to $34, though most investors still weren't worried because silver had spent 45 years trapped below that $50 ceiling from 1980, and everyone assumed it would stay there forever. October 2025 proved them wrong when silver finally broke through $50, then December's thin holiday trading sent it surging to $83. January 14th, 2026 brought an intraday high of $92.25, with some exchanges recording prices as high as $93.77. That 147% gain in just 1 year from 2024 to 2025 looks even more extreme when you zoom out, because from January 2025 to January 2026, silver has surged 195% year over year. Gold rose 67% during the same period. Silver didn't just outperform gold, it crushed it. Here's where it gets interesting, because this isn't a bubble. What we're watching is a genuine supply crisis that's been building for 5 straight years. 5 consecutive years of structural deficits have hit the silver market, meaning demand exceeded mine production every single year. 2021 saw a deficit around 50 million ounces, then 2022 exploded to 253 million ounces. Another 200 million ounces disappeared in 2023, followed by 148 million ounces in 2024, and 2025 projections show another 117 million ounces headed for the shortage column. When you add it all up, the world has consumed approximately 800 million ounces more silver than it produced over the past 5 years, which equals about 10 months of total global mine output. Just gone. Nobody can fix it quickly either. And that's because 70% of silver comes as a byproduct from copper, zinc, lead, and gold mining. Miners can't just dig more silver when the price goes up because they're mining for other metals and silver comes along for the ride. Opening a new mine takes 10 to 15 years from discovery to production, which means today's shortage won't be solved by tomorrow's supply. The physical market is screaming right now. COMEX registered silver inventories have collapsed 79% from their 2020 peak, dropping from 346 million ounces to just 73 million ounces, while LBMA vaults in London dropped 30%. Lease rates, which measure how much it costs to borrow silver, spiked to 200% annualized during acute shortages in 2025. This is what a genuine supply crisis looks like. Supply is only half the story though, and the real game changer is what's happening on the demand side. This is where silver becomes unlike any other precious metal. 2024 brought record industrial demand for silver at 680.5 million ounces, marking the 4th consecutive year of record industrial demand. Industrial users now represent 59% of total silver consumption, up from about 50% a decade ago, while gold by comparison remains primarily a monetary asset and jewelry metal. Silver is what you need to build the modern world. Solar panels tell the first part of this story. 2514 saw solar accounting for just 5% of total silver demand, but by 2024 it consumed 197.6 million ounces, representing 17% of total demand, a 21% increase year over year. What nobody's talking about is how the shift to newer, more efficient solar panel technology called TOPCon cells uses 50% more silver per panel than the previous generation. Research from the University of New South Wales warns that solar industry growth alone could exhaust 85 to 98% of global silver reserves by 2050, and by 2030, solar panels are projected to consume 29 to 41% of total global silver supply. Each solar panel requires about 15 to 25 grams of silver, and there's no substitute that matches silver's electrical conductivity at scale. Electric vehicles add another layer to this demand story. Traditional internal combustion engine cars use 15 to 28 grams of silver, hybrids use 18 to 34 grams, but a fully electric vehicle needs between 25 and 50 grams. That's 67 to 79% more silver than a conventional car. And we're just getting started with EVs, since projections show electric vehicles will overtake traditional cars as the primary source of automotive silver demand by 2027. Solar and EVs are big, but what's coming next could dwarf both of them. Samsung has developed a silver carbon solid-state battery technology that's entering production right now, offering longer range, faster charging, and better safety than current lithium-ion batteries. The catch is they're incredibly silver intensive, requiring about 5 grams of silver per battery cell. A 100 kilowatt-hour electric vehicle battery pack could need up to 1 kilogram of silver, which equals 32 troy ounces per vehicle. The math gets scary fast. Just 20% of the global vehicle fleet adopting solid-state batteries creates additional annual demand of 16,000 metric tons of silver, which is 62% of current total supply. Push adoption to 50% and you're talking about 40,000 metric tons, exceeding total global mine production. Mass market production is expected to begin in 2026 to 2027, which means this year and next year. Semiconductors and electronics haven't even entered the conversation yet, but they consumed 445 million ounces in the electronics and electrical sector during 2023, a 20% year-over-year increase. Silver's electrical conductivity remains unmatched, making it indispensable for integrated circuit interconnects, printed circuit boards, multi-layer ceramic capacitors, and RFID antennas. Semiconductor packaging alone consumes 200 to 1,500 metric tons annually on a global scale. 5G infrastructure adds another dimension to the demand picture, with silver demand for 5G and Internet of Things applications projected to increase 200% by 2030, reaching 23 million ounces. 71% of smartphones were 5G enabled by 2024, and every single one of those phones needs silver. Artificial intelligence is multiplying the problem too, because IT power capacity has increased 5,252% since 2000, climbing from less than 1 gigawatt to 50 gigawatts in 2025. More AI servers means more computing hardware, which means more silver in connectors, switches, and cooling systems. Every electronic device with an on-off switch likely contains silver, so we're not talking about luxury items anymore. We're talking about the foundational materials required to build our digital future. You're probably thinking silver crashed spectacularly before, and you'd be right. Twice, actually. 1980 saw the Hunt brothers try to corner the silver market by accumulating between 100 and 200 million ounces, about 1/3 of the tradable supply, driving the price from $6 to $49.45 per ounce. March 27, 1980 became known as Silver Thursday when the price crashed 50% in a single day after the COMEX exchange changed its rules and they couldn't meet their margin calls. A $1.1 billion bank bailout was required to save them. 2011 brought another spectacular rally when silver climbed from around $9 in 2008 to $49 in April 2011, then crashed from $49 to under $26 in less than a month. The Federal Reserve didn't announce expected quantitative easing and exchanges raised margin requirements, triggering the collapse. Silver has a history of violent crashes, that's undeniable. But here's the difference worth understanding. 1980 and 2011 both had market surpluses, with rallies driven by speculation and market manipulation. Today, we're looking at an 800 million ounce cumulative deficit and genuine structural industrial demand drivers that won't just disappear. Ned Naylor Leyland from Jupiter Asset Management put it this way: the thing about silver is, if you don't have it, you can't build anything. Whether it's electronics or white goods or missiles or cars, you don't have it. You can't have it. Expert predictions on silver's next move vary wildly, but they all point up. Michael Widmer at Bank of America projects an average price of $65 for 2026, though in aggressive scenarios, he sees silver potentially topping out between 135 and 309s. HSBC forecasts an average of $68.25, while UBS suggests $60 to $65, and Citigroup predicts a $40 to $70 range. Independent analysts are even more bullish. Alan Hibbard from Gold Silver said, and I'm quoting here, I'm expecting silver to perform better in 2026 than it did in 2025, which saw that 147% gain, adding, I wouldn't be surprised to see the price of silver increase by over $100 per ounce. Ned Naylor Leyland says $100 is absolutely possible. The bearish case exists too though. James Steele at HSBC cautions that silver may be fundamentally overvalued at current prices, pointing out that high prices could trigger demand destruction with industries finding ways to use less silver. Solar manufacturers are already working on reducing silver content by 15 to 20% per panel. Jewelry demand is vulnerable to price sensitivity, and rising real yields would pressure all commodities. Physical silver offers the most direct exposure if you're considering jumping in. Coins, bars, and rounds are all available, but premiums have exploded recently. American Silver Eagles normally trade a few dollars over spot price, but they were commanding $20+ premiums in 2025 because US mint production collapsed from 3.56 million coins in January 2025 to just $305,000 in July. Generic rounds and bars offer lower premiums, typically $3 to $15 over spot. ETFs provide easier trading for those who want it. The iShares Silver Trust with ticker SLV is the largest, holding $19 to $33 billion in assets and returning 113% in 2025. Sprott Physical Silver Trust, using ticker PSLV, returned 128.7% and stores its silver in the Canadian Mint, while AGQ offers 2x leveraged exposure for aggressive traders and returned 272% last year with extreme volatility attached. Mining stocks give you another route in. Pan American Silver operates as the largest primary producer. First Majestic Silver generates 57% of its revenue from silver, and Wheaton Precious Metals uses a streaming model, buying future silver production at fixed prices as low as $5.75 per ounce. Kerr Mining was up 229% year-to-date in 2025. The risks here are substantial and deserve your full attention. Exchange rule changes could trigger mass liquidations just like they did in 1980 and 2011, and silver's 147% rally in 1 year creates severe pullback risk all by itself. Extreme volatility defines this market. Strong US dollar moves pressure all commodity prices, and an economic slowdown would cut industrial demand immediately. Industries are actively working to reduce their silver intensity too, which could ease demand faster than anyone expects. RIA advisors put it bluntly when they said, "We are reasonably confident that this bullish charge in silver will end poorly as it has in the other two instances. What we don't know is when." Silver has broken through $90 for the first time in history, driven by a perfect storm of 5 consecutive years of supply deficits, record industrial demand from solar panels, electric vehicles, and semiconductors, plus the looming commercialization of solid-state batteries that could consume more than half of global supply. The gold-to-silver ratio hit an all-time high of 125 to 1 during COVID, but has compressed to around 57 to 1 as silver surges, moving closer to the 20th century average of 50 to 1. Major banks are forecasting prices between $60 and $135, with some aggressive scenarios reaching $309, while independent analysts predict $100 to $175 and possibly higher. This is an extremely volatile market with real risks attached, make no mistake about that. What separates now from 1980 or 2011 comes down to genuine measurable supply deficits and structural industrial demand versus pure speculation. The question isn't whether we need silver, because we absolutely do. The question is whether supply can catch up, whether industrial users can reduce their consumption, and whether the price has already run too far too fast. Silver has entered uncharted territory, trading at levels even the Hunt brothers never achieved, whether it reaches $150, $200, or crashes back to $60 depends on how this unprecedented supply-demand imbalance resolves itself. The final warning is this: something fundamental has changed in the silver market. What you do with that information is up to you.